So our next panel is moderated by Tim Yeager. Tim is a professor of finance and holds the Arkansas Bankers Association chair in banking at the University of Arkansas. I guess closer to home, though, Tim was with the Federal Reserve Bank of St. Louis prior to moving to Arkansas to take that position. He received his doctorate in economics from Washington University in St. Louis. So, Tim, I'll turn it over to you.
Good morning, everyone, and thank you, Julie. This is my fourth out of the 5 community bank conferences that have been here at the St. Louis Fed, and I must say, like many others have noted, I am quite impressed with the increasing quality of this conference. It's always been great, and it's getting better. And so I thank Julie and Jim Fuchs and everybody who helps to put this program together. When I was asked to moderate the session, I didn't know what papers I was going to receive. I ended up receiving 3 papers, and they are, as you will see, extremely interesting. I think that bankers will have quite a bit of interest in these topics and these papers and have a lot of experiences that you can relate to. And so maybe I don't have to tell you this, but I really encourage open communication. Don't hold back just because there's regulators here. I promise. I used to be on that side. We won't mind, right? Nobody in the room will mind. And I think everybody will benefit from open, constructive criticism. And so I'm really looking forward to the dialogue. So what these papers do, they address various frictions or market failures that are inherent in credit markets. And the Small Business Administration's program intends to assist credit-worthy small businesses where the risk from a purely private loan may be too high for many banks to take by themselves. So the government partners with the bank by absorbing much of the default risk. And John Hackney, assistant professor of finance at the University of South Carolina, is going to assess the impact of that SBA guarantee on small business lending, especially during the financial crisis. The Community Reinvestment Act incentivizes, which is a kind way to say that, incentivizes banks to lend to borrowers in low and moderate income areas to reduce the effects of discrimination and to ensure that a bank serves customers in the entire market area. Yewei Du, assistant professor at New York University, asks whether the CRA forces banks to disclose geographical lending information that could lead to a deterioration in loan underwriting or loan quality. Taylor Begley, assistant professor at Washington University, right here, asks whether the CRA mandate leads to a deterioration in the quality of credit that is provided to poor and minority customers. So let's please welcome as the first speaker, John Hackney.
Hello, thank you for having me. I'm part of the large crowd of South Carolina people that you've already heard from. I haven't asked a question yet, but we travel in groups, and you know that the interest in community banking is alive and well in Columbia, South Carolina, so that's good. All right, so if you were to just go on Google, type in small business lending during the crisis, as I did to get this picture, this is what you'd see. You'd see something like this. Okay, and this is a picture that you all experienced, you all know. Small business lending during the financial crisis just basically dropped off a cliff, right? And so you see that in this picture, and they at least, they say they're using the FDIC data, or they're using legitimate data, but let's put some real numbers to that. From 2008 to 2011, one paper estimates small business volume declined 18%. And that's relative to a total decline for all business borrowing of 9%. So everybody went down, but that was especially big for small business lending. And so why is this a problem at all? As we know, small businesses are a large and very important part of the U.S. economy. So they generate roughly half of private non-farm GDP, and they create the majority of the net new jobs, right? So this is something that we know. And we know that they're funded predominantly by banks, right? 60% of the borrowing small businesses do, it comes from commercial banks, right? So this really disproportionate drop in small business lending could have really negative implications for small business investment and real outcomes at local levels. So this is something I think we all understand intuitively. And policymakers recognize this as well. So in 2010, Ben Bernanke said that making credit accessible to sound small businesses is crucial to our economic recovery, and so should be front and center among our current policy challenges. Right? So there's this recognition among policymakers that this is really important. It's concerning that small businesses were kind of cut off from credit markets during the crisis. Okay, so that's the question I'm going to try to address in this paper, is whether and how policymakers can help to ease the financial constraints for small businesses, and especially during crisis times where they're particularly constrained. Okay? As an academic, usually we're very free market, so anytime you say government intervention, academics immediately get their hackles up, but as we know, when there are private market frictions, there's a potentially positive role. And the way that I'm going to do that, as Tim said, is I'm going to look at the SBA's 7A Guaranteed Lending Program. Okay, so this is the largest, it's the longest running program that's specifically targeted at small business lending. And it provides a partial guarantee for small business loans that are granted by participating lenders. And I'll talk more about that in just a second. Okay, so what I'm going to do is I'm going to look at the local proportion of SBA lender branches within a county. Right? So the proportion of SBA branches over total branches, and see whether that affects the amount of small business credit that was granted during the crisis, and then also how that affected small business outcomes. Okay, so did this government guarantee, did this general availability of the government guarantee allow banks to lend to small businesses when they really needed loans? Okay, I'll also talk a little bit about controlling for local demand and supply effects. I won't spend too long on the actual nitty-gritty of the statistics, but we can talk about that later. Okay, so what I find is the more SBA lender branches you have in a county, the more lending you got during the crisis to small businesses. And this is especially true of small businesses with less than $1 million in annual revenue. Okay, so the smallest businesses, they see the biggest increase in volume related to the presence of SBA lenders. I also find that the local real outcomes improve. Right? So you get future unemployment going down, and you also get employment and establishment growth, but only for the smallest firms. And that's important for a reason I'll discuss in a second as well. And those results seem to be coming from hiring, right? So hiring by the smallest firms. And the last thing I'll talk about is the SBA loan outcomes, right? So what happens to these loans that are granted during the crisis? Are they good loans? Are they bad loans? So I'll do that analysis as well, and I'll show that these loan outcomes don't worsen, right? Which suggests that they weren't bad loans. They were to viable small businesses. Okay, so what does the 7A program do? Everybody in this room probably knows, so this is a very high level, and there are different specifics, and these things vary a little bit, but this is just at a high level. The bank provides the capital, it does the screening, it does the monitoring, the ongoing servicing of the loan. It has to follow all the specific SBA underwriting guidelines, submit to SBA review, and there's some costs associated with SBA lending, such that only about 5% of the originations in small business loans are SBA loans, right? So it's still a relatively small proportion of total small business lending. Okay, the SBA, for its part, guarantees up to 85%, and this guarantee level varies depending on the program that's used, and it also changed a little bit with some of the legislation that was passed, especially at the tail end of the crisis. But the general takeaway is there's this partial guarantee for SBA loans. And then there's also a capped interest rate, right? So you can only go up so high on the interest rate. And then the borrower has to meet certain size and use of proceeds rules. And then they also have to meet this credit elsewhere requirement. And this is important. Essentially, the borrower and the bank have to certify that the borrower wouldn't be able to get credit at, quote, reasonable terms anywhere else without the SBA guarantee. Okay? So essentially, they have to exhaust kind of their alternative forms of reasonable forms of alternative financing before they're eligible for an SBA loan. Okay, so that's just kind of the very general picture of how the 7A program works. Okay, let me just take a step back and talk about small business lending in general. There's been a lot mentioned already about soft information, and this is something that really characterizes small business lending. So usually there's a lack of kind of a long financial history. There's a lack of this quantifiable information that leads to banks relying on relationship lending, relying on soft information. And what that means is there's you can't really have a standardized underwriting procedure, right, that's scalable, that applies to all small businesses. They're very different, right? And they're also very risky, right? Small businesses fail at a high rate. And so these features not only make small business loans, kind of risky, but they make them largely illiquid, right? You issue small business loans, and a lot of time they just stay on the balance sheet. Okay, and importantly, during the crisis, both bank liquidity and their ability and willingness to take on risk, both those things took a hit, right? So this could be kind of a supply-side story of why small business lending dropped off so much. Certainly there are demand reasons as well. Demand for loans dropped, but this is kind of the supply-side story. Okay, so how can SBA lending help? Well, obviously the partial credit guarantee provides some insurance, right? If the loan fails, the SBA comes in and they pay a certain percentage of the remaining loan balance, right? So that relieves some of the credit risk, and it also provides liquidity. So the SBA kind of supports this active secondary market for the guaranteed portion of the loans. Right? So banks can make the SBA loan and then immediately move that guaranteed portion off of their balance sheet, right? So it almost directly addresses this credit risk and liquidity concerns. Okay, so let me just jump right in and let you know that I'm just going to highlight one row on this, which I'll highlight. I'm not going to talk about the regression equation or anything like this, but I'm especially concerned with these numbers. So what I'm doing in this regression is I'm looking at the effect of SBA, local SBA branch share within a county during the crisis, how that affected small business loan growth. And I have the two different definitions: loans with initial amounts less than $1 million, and then firms with less than $1 million in annual revenue. Right? And so what you see is that during the crisis, the counties with the larger share of SBA branches, they saw more small business credit growth. Okay, so that's the takeaway, the volume increases, and especially for the smallest businesses, those with less than $1 million in annual revenue. Okay, and just to put this in kind of real terms, if you have a standard deviation increase in the proportion of SBA branches, that's about $9,000 more per 1,000 people. Right? So just back of the envelope calculations, if the median county size is about 30,000 people, this is between 9 and 10 new small business loans during the crisis to the smallest small businesses. Okay, so the interpretation of the results, as you've seen through all these presentations, a real theme in academic research is being able to say whether something causes something else, right? And that's especially important for policy. So is the local proportion of SBA branches actually causing small business lending to go up? Or is it just correlated with kind of local economic conditions, right? Maybe they're just located in areas that did better during the crisis that have higher demand. Maybe it's some other characteristic of the local banks that's just related to SBA lending that's the real driver. Okay, I have a couple reasons to believe this is not the case. And the ones I'll talk about, so I'm including controls in these regressions for local demand and supply, which if you're really curious what all the controls are, you can ask me about it, or they're all in the paper. And then I'm also going to look at outcomes for large firms, local large firms. And these are kind of a placebo group. So if the proportion of SBA branches is just related to local economic conditions, then you should see it also related to how the large businesses do during the crisis, right? And importantly, these large firms, they're not eligible for the SBA loans, right? So I want to see no effect for the large firms as kind of the placebo group. So looking at employment and separating into large and small firms, all the positive effect is coming from employment at small firms. And you get a negative coefficient that's insignificant for the large firms, which is good. So it doesn't seem to be related to something that's going on at the local level. It's only affecting the small firms. Okay, so that's the first piece here. Another question you may ask is, okay, well, where is this coming from? Is it coming from SBA lenders just allowing businesses to hunker down, right, to not fire anybody, or are they expanding, are they hiring employees? Right, so you can further separate the data into hiring and firing, and this is again looking at large firms and small firms. So you see that there's an increase in hiring at small firms, and there's actually a decrease in hiring at large firms. Okay, so this seems to be coming from the hiring side rather than a decrease in firings, which are nicely called separations here. That's a much nicer word. Okay, I'll also look at 1 year ahead unemployment. So if you know that employment for small firms is increasing, maybe it has effect on overall unemployment. And again, there are a lot more controls in these regressions that I'm just kind of glossing over, but just looking at some of the real outcomes, the proportion of SBA branches during the crisis means you'll have lower future unemployment. Okay? All right, so takeaway so far, prevalence of SBA lenders leads to more small business loans and larger employment during the crisis, but again, only for small firms. I also look at establishments, but I don't have this here. And I think a last important question is, okay, loans increase or credit increases, small businesses expand, but were these actually good loans? Maybe what I'm seeing is firms that just hadn't defaulted yet. Maybe these aren't really that good of loans. And so what I do in this last bit of analysis is I look at outcomes for the SBA loans themselves. And specifically, I'll look at the default rate of the SBA loans, and I'll look at the charge-off rate. Okay, and so let me again just highlight. What I find here is that default and charge-off rates decline. Well, the default rate declines, and the charge-off rate is 0 statistically. Okay, so you don't see a decrease in the quality of the SBA loans. And what this suggests to me is that the pool of SBA borrowers actually got better. So as you got businesses that couldn't get a traditional loan, they were moved into the SBA program during the crisis. So to me, kind of the preponderance of the evidence, taking all these pieces together, suggests that the SBA was helping banks to fund viable small businesses during the crisis. Okay, so kind of the policy implications at the end. In the presence of these private market frictions, there's a potentially positive role for the government. Right? And the results suggest that the SBA guarantee allowed the banks to extend credits to financially constrained but viable small businesses. Okay? The last thing, I'll put the disclaimer, this isn't the whole picture. All I want to say in this paper is there was a beneficial role for the SBA program. That this isn't to say that it's the best way to do things or the only way or the most efficient, but it does say that it had a positive effect, right? So there's something that can add to the debate in this area. Thank you.